In this world, nothing is certain except death and taxes. You've probably heard that famous quote a million times. It's just a reality we all share. But honestly, for something that is so incredibly universal, the actual nuts and bolts of taxation are just, well, they're confusing for most of us. I mean, you earn money, you buy things, you own property, and it feels like everywhere you turn, a little percentage is taken away. But where is it actually going? And maybe more importantly, how on earth is it calculated?
Hey everyone, and welcome to this explainer on the U.S. tax system. I am super excited to be your guide today as we finally demystify exactly where your hard-earned money goes. If you're someone who really wants to understand the actual mechanics behind what gets pulled out of your paycheck and why it happens, you are in the exact right place. We are going to dive straight into the data and the laws to make this totally complex machine understandable. And, dare I say it, maybe even a little bit fascinating. All right, so here is our quick roadmap for today. 1. The purpose of taxes. 2. Demystifying the income tax. 3. Payroll taxes explained. 4. Property and sales taxes. And finally, 5. The IRS and you.
Okay, so when we talk about taxes in the US, it really often feels like we're paying an absolute premium, doesn't it? But let's actually take a step back and look at the global perspective for a second. Back in 2020, the total taxes collected by all the federal, state, and local governments in the US made up about 25.5% of our gross domestic product. Now, compare that to the OECD average, which represents a lot of the world's developed economies. Their average is sitting way higher at 33.5%. So the real takeaway here is that while our tax code is definitely undeniably complicated, our overall macroeconomic tax burden is actually quite a bit lower than the international average.
But before we get totally lost in today's numbers, let's briefly look at how we even got here. Because, believe it or not, it wasn't always this way. The very first U.S. income tax wasn't even implemented until 1861 when Abraham Lincoln needed to help fund the Civil War. It actually lapsed after the war, and when the government tried to bring it back later, the Supreme Court straight up ruled it unconstitutional in 1895 during the Pollock case. It took a literal, physical change to the U.S. Constitution, the 16th Amendment, which was ratified in 1913, to give Congress the permanent power to collect taxes on incomes. Moving on to Part 2, demystifying the income tax. This is, for most of us, the biggest hit to your wallets. So really grasp how the income tax works, you absolutely have to understand this one core definition. The United States uses what's called a progressive tax system. Simply put, this just means that the rate of tax generally increases as your taxable income increases. So higher income earners pay a greater percentage of their income in taxes compared to lower income earners. Makes sense, right? But how this actually applies to your specific paycheck is wildly misunderstood.
And that brings us to the absolute biggest misconception that taxpayers have. It's the difference between your marginal tax rate and your effective tax rate. Your marginal tax rate is just the top rate applied to the very last dollar you earned. But your effective tax rate, that's the actual average rate you paid on your total income. I mean, I hear people say all the time, oh, I don't want to raise because it's going to push me into a higher tax bracket and I'll end up taking home less money. Guys, that is mathematically false under our system. Reaching a higher tax bracket does not mean all of your previous income is suddenly taxed at that new higher rate. Let's actually walk through the math to see how this works using two imaginary taxpayers, John and Jane. Based on the 2026 tax structure, let's say John has a net taxable income of $100,000. That drops him into the 22% marginal tax bracket. But here is the kicker. His first $12,400 is only taxed at 10%. The next chunk is taxed at 12%, and only the amount he makes above $50,400 is taxed at that top rate of 22%. Because of this bucket system, his actual effective tax rate, what he really pays overall, is just 17%. Now let's look at Jane. She makes exactly double what John makes, so $200,000. Her marginal tax bracket is 24%. But because she's using that exact same progressive bucket system to fill up those lower tax brackets first, her effective tax rate is only 20%. The system is definitely progressive, but your top marginal bracket is literally just a cap that only applies to your top dollars, definitely not your whole salary.
So if breaking down that huge tax bracket myth just saved you a major future headache, or hey, if you finally feel confident asking your boss for that raise, take a quick second to hit the like button on this explainer and subscribe. It really helps us keep creating these focused financial insights for you. All right, next up, payroll taxes explained, understanding your pay stub.
15.3%. I want you to literally keep this number in your head for a second. This represents the total self-employment payroll tax in the United States. Now, if you are a regular W-2 employee, you might be scratching your head thinking, wait a minute, I definitely don't pay that much. And you're right. That's because W-2 employees split this exactly 50-50 with their employers. You pay half out of your check, and your company secretly pays the other half behind the scenes. But if you work for yourself or you operate as an independent contractor, yep, you are on the hook for the entire 15.3%.
So what exactly is this 15.3% actually paying for? Well, the lion's share of it, 12.4%, goes directly to Social Security, which provides old age, survivor, and disability insurance. The remaining 2.9% funds Medicare, specifically hospital insurance. Now, here is a super fascinating detail. The Social Security tax only applies to wages up to a certain annual cap. It usually sits around the $170,000 to $180,000 mark depending on the year. Every single dollar you earn beyond that cap is totally immune to the Social Security tax. The Medicare tax, however, that applies to every single dollar you earn. There is absolutely no cap.
In fact, to kind of further the progressive nature of the U.S. tax system, high earners actually end up paying more into Medicare. If you make over $200,000 in a calendar year, you're hit with an additional 0.9% Medicare surtax. It's really just another way the system attempts to balance the overall tax burden based on an individual's earning power. Moving right along, property and sales taxes, taxes on what you own and what you buy.
So property taxes are entirely an animal of state and local governments. There's actually no federal property tax at all. Most local jurisdictions base this tax on the fair market value of your real estate, and these funds go directly toward local needs, like funding your neighborhood schools. But here's a wild fact. It's not just houses. In some states, like Virginia, for example, they actually maintain a personal property tax on your motor vehicles. So yes, depending on where you live, you could be paying an annual tax simply for the privilege of owning your car.
Then, of course, we have the sales tax, which applies to your retail purchases. Unlike a lot of other countries that have a national VAT, the U.S. has absolutely no federal sales tax. It is completely up to the states and the local municipalities. Imagine you buy a brand new laptop in Delaware. You pay 0% state sales tax. Buy that exact same laptop over in California, and boom, you are hit with a 7.25% state sales tax. And that's not even counting the potential extra local city taxes on top of it. Literally, where you physically stand when you hand over your credit card drastically changes your consumption tax burden.
Okay, final section. The IRS and you, the enforcer and administrator.
Before we actually look at the agency itself, I think it's worth taking a breath and just reminding ourselves why this massive collection apparatus even exists. Your federal tax dollars go toward the public goods and services that really shape the fabric of the country. They fund Social Security and Medicare benefits. They fund the absolute entirety of our national defense. They provide economic security programs. They support medical research, and they pay for veterans' benefits. It is the collective pool that keeps the whole national engine running. And the IRS, well, they are the engine room. While they're almost always viewed strictly as the bad guys or the enforcers, their core functions cover a ton of ground. Yes, they process hundreds of millions of tax returns, and yes, they collect the taxes due. Yes, they enforce the tax laws through audits and assess penalties, but they also provide written guidance and assistance to taxpayers who are just trying to navigate this incredibly dense set of rules. You have to remember, they are the administrators of the U.S. tax code, definitely not the authors of it. That job belongs entirely to Congress.
Wow. Okay, we have covered a tremendous amount of ground today, from the reality of progressive income brackets all the way to local property taxes. If this explainer helped clear up the fog around the U.S. tax system for you, please give that like button a click and subscribe to the channel to keep empowering your own financial journey. Because really, understanding the system is the absolute first step to optimizing your life within it. Knowing the difference between your marginal and effective tax rates, understanding those payroll deductions, and recognizing the massive local impact of property and sales taxes gives you a huge advantage. So I'm going to leave you with this final thought. Now that you know exactly how the system works, how are you going to strategize your finances differently for the next tax season? Start planning right now, and I will see you in the next explainer.